welcome to TheoTrade. This is Don Kaufman. It's September 20th, 2019, and you are watching the TheoTrade Weekend Update. We got another week in the books. We just passed through a Fed announcement. We got quadruple witching under our belt. A little bit of volatility, of course, late this week. But the unexpected, the repo market. I mean, listen, up until this week, there's a term that most people, that if you're not in the financial markets, you've never even heard before. Effectively, yeah, we're going to talk a little bit before we get into some details about some of the action inside of the markets, which we will do here momentarily. We'll take a look at a couple of charts. Yeah, we have to talk a little bit about the repo market. For those of you, if you're kind of brand new to the idea of the repo market, it's a short-term funding market that literally seized earlier this week. And quite frankly, when it comes down to the repo market, listen, we have some really detailed explanations, we did in the chat room, of course, on Wednesday throughout the course of this week. Just to keep it kind of short, keep it kind of sweet. Again, the repo market seized, but that's all that mattered coming in to the Fed meeting. You know, prior to this week, I was in the camp that, no, the Fed, they're probably not going to turn around and cut rates again. Of course, we were dead wrong, right? The Fed, they cut by a quarter point, but everything changed in the moments leading up to the Fed announcement because effectively, we had one of our financial markets right here in the US that literally the entire world is dependent upon for short-term funding, completely and totally seized. And I said, not only did it change everything for the Fed announcement, but it changed everything moving forward. And it's, that's an aspect that I don't think is being discussed enough is, first of all, everybody's asking what is the repo market? As I said, it's, short-term financing, short-term funding. It's be able to actually carry some debts moving forward. There's no capital left in the cookie jars. The Fed comes in and they start injecting liquidity. You immediately think like, what is this? China? Open market operations? But whether you understand the repo markets or not, what I want you to understand is a very simple reality. It appears, that this could be the onset of another round of quantitative easing. Because one way or the other, there's not enough capital out there. They need to inject liquidity. Now in the repo market, it's not considered quantitative easing when they go inject $75 billion a few days in a row. Right, it's not considered quantitative easing, but you better believe, that this is going to build into, again, another round of quantitative easing. Maybe not today, maybe not tomorrow, maybe not even a few months from now, But rest assured, we are headed back that direction. And again, that changes the entire scope effectively moving forward, whether you're bullish, whether you're bearish. That's some of the details that we're going to bring to you here momentarily, when we get to a couple of charts, a few trade ideas, and a whole lot of individual stocks to look at. Listen, this has implications throughout the entire financial system. With that, we're going to get right down to it. We've got a lot to discuss in this weekend's update, a lot of charts to take you through, a lot of trade ideas. Let's get to it. To the charts and trades we go. We start this weekend's update here on the charts, specifically inside of the SPX. You kind of look at this entire week, and it was one of the most highly anticipated recent weeks in history, right? It was the FOMC meeting. It was the meeting where we were largely divided as to what was going to occur. And it wasn't just the FOMC. It was Bank of Japan. It was the Swiss National Bank. I mean, we can go on and on about all the different central banks that spoke this week. But you kind of look at this and you're like, we ended up almost massively unchanged. I mean, what you're looking at right now in this chart is the SPX. And the SPX started the week right here. And here is just north of the 3,000 level inside of the SPX. Where did we end up the week? 29.92. Now, in a minute, you're actually going to see, we're going to go through a bunch of different stocks that are moving, people. I mean, are moving. But you kind of answer this question here. Are we really massively unchanged? The S&Ps received quite a degree of rotation. So they don't look like, again, they got rocked at all. But take a look at a few of the other major index and indice products. And I'll start over here on the Russell, which actually had a rather rough week. And I want to specifically pull up this auto expected move, because something we look at kind of week in and week out is how did the market move relative to what the options market depicted it to move. And you can see the Russell, for example, tagged right onto the edge of the expected move. How did the Nasdaq do? Here we're actually pulling up the QQQs. Okay, very similar in terms of like that, again, sell side activity that hit kind of late in the week. Again, big rotations of capital throughout the course of the week. Now, I'm going to jump back to the SPX. So I'm going to go back to the SPX because one other aspect that really kind of resonated with me had everything to do with historical volatility. That is actual price movement inside of the market. If you look at the last, couple of trading sessions, you're at 1, 2, 3, 4, 5, 6, 7 trading sessions where all of a sudden you start to recognize we've done absolutely nothing. Anticipate that price movement, it's going to be a rockin' again coming into next week. Now, don't necessarily just take my word for it. What we're going to do here, and one of the last things we're going to do, on this weekend's update, is we're actually going to take a look at the SPX expected move. Again, I will come back to that a bit later. But before I go any further, we've got to talk. It's about the bonds. The bid under the bonds is back, baby. All right? Let's just cruise directly over the bonds. The bonds, they just speak volumes right now, of this marketplace. So some fairly wicked sell side activity grips hold to the bonds. Now, we had some positions, some back spreads that were extraordinarily profitable. At a point in time, we closed them all out. We've actually got another few trades popped on the TLT, once again looking for a move either higher or lower. I want to reiterate that again. We've actually got what is termed an infinity spread, which we're actually looking for an explosion higher or lower inside of the TLT, and that is a pretty good start to that move. Now, the bid back under the bonds. Let's just kind of run through a couple of different ideas. Listen, just because we've seen, a week of buying inside of the bond product doesn't necessarily mean that's it, and we're just going to, sail off, higher and higher on the bonds. But I have to tell you, if you take a look, at the interest rate, and the interest rate that I like to look at is the TNX, that's the 10-year Treasury Index. The 10-year Treasury Index, it's just an all-out crash. I mean, all-out crash at the downside. We get a bid back under us, and now it appears that we might be, substantiating another leg down of rates. Listen, I cannot tell you, the next move of rates, nor can anybody. There's no technicals that are going to tell that, It's right now, it's all about order flow, And you're going to, in just a minute here, we're even going to talk about, there's a total Fed free-for-all. So you don't even have to listen to what's going on right now. The Fed's going to be a complete free-for-all for the foreseeable future, which I'll explain here in a moment. The bottom line with the interest rate, the bottom line with the bonds, First of all, you don't have to look too far. Look at the longer duration trend on the TNX. Now, I talk about this very often. When I say longer duration trend, I'm all the way back here 20 years, I don't know. I'm starting to see a little bit of a trend in the 10-year Treasury. Listen, we are on a path to where rates are probably going to go down. Inverse to that, of course, would be those bonds. So again, as I said a moment ago in the video portion over here, maybe not today, maybe not tomorrow, but you can rest assured that sooner or later, these bonds, they are going to bid back up. And that may have to be in for like a little bit of duration over there. Nevertheless, we anticipate the bonds are going to catch that bid back to the upside, regardless of what we might believe here per se in the short term. Now, if these bonds, are going to bid back, listen, that is going to be a very difficult time for the financials. Specifically, let's go ahead and pull up the XLF, the financials, okay, how are they going to fare in a lower interest rate environment? And again, you don't have to look very far to get an answer to that. Simply look, and there was actually a video we did a few weeks ago on this, okay, at the European banks. If you take a look at the European banks, they're all sitting at 20 plus year lows. I mean, you can go through, and again, this is where I was like, bring up a couple of max charts over here. There's the XLF, and then you start bringing up, oh wait, should we bring up like Deutsche Bank? Huh? Nah? No, that's not even fair. Okay, we could bring up like Credit Suisse. Okay, there you go. There's Credit Suisse. You could bring up something like UBS. Okay, Royal Bank of Scotland. I mean, I can go through them all. I could just pull them up off the top of my head again and again and again and again. I mean, this is what it looks like when you are in negative interest rate policy. I'm not saying per se that that's going to occur here, okay, the negative interest rates. Nevertheless, when you're sitting at, again, 20, 25-year lows and interest rates, they're not looking like they're going to go up. We're not in that dissimilar of a position. So one of the things that I continue to kind of reiterate is, again, this is not a trade per se, but it's more of a duration position, okay, whereby I like the idea of being short those financials. And if I like the idea of being short the financials, okay, it kind of also means I like the idea of being short the overall marketplace, because the financials, they're a pillar inside of this marketplace. That may not be true 5 or 10 years from now, but the financials are an absolute pillar inside of the entire S&P 500. And that, people, is what brings out, okay, the bear in me. So you better watch out in the financials, okay? The TLT, again, the TLT, we're looking for infinity spreads. The financials, I'm just a duration short, okay? And what better place, and I'll reiterate another position, okay? What better place to look than something like JP Morgan, which is at, again, you can pull up JP Morgan for 10 years. You can pull up JP Morgan, okay, from the history of this company. We are looking at all-time high. All right, if you're gonna short something, hey, why not short into the all-time high? But mark my words, you're gonna have to sustain this position for quite a period of time. All right, so the next thing I bring up over here, well, the rest of the world's negative rates. Okay, why not us? I already kind of let the cat out of the bag over there. And that is, again, the constant, if you will, pressure on the U.S. markets. The way to position this is a very simple idea, okay? You look at bond markets, and people get very confused when they look at the bond market. If you've never traded, like, futures markets, listen, when you buy a bond, okay, when you buy the bonds, or, example, you buy the notes, it actually pressures, okay, this interest rate to the downside. Now, here's my take. Our 10-year, and this again is the TNX, is sitting right now about 1.75. I know it says, 17, but that is 1.75% on the 10-year, period. All right. If you have Japan in negative rates, if you got most of Europe in negative rates, sooner or later, okay, here's North America. That is the worst, North America ever. Here's Europe. Money comes over here. Here's Japan. Money comes from there. It comes from all over the world, okay, flooding into the United States. Why? I don't know, because we're paying better than they are in the end. And I hate to wrap everything up in this nice, tidy little basket, but in the end, our crap is going to be better than their crap. I mean, that's what it comes down to. When I say crap, I mean debt. All right, our debt is going to be sustainable probably beyond them. Hey, if we're all going bankrupt, we're not going down first. That much I promise you. And that's one of the ways to look at the debt markets right now is, say, sustainability. They're already in negative rates. They're already scrounging. Okay, but here in the U.S., no, we have 1.7%. Yeah, until everybody realizes that and capital starts to flood in. They start buying the bonds and the interest rate effectively goes down. All right, the rest of the world's in negative rates. Doesn't necessarily mean we're headed that direction, but it's going to keep that constant pressure, okay, on the interest rate, which in effect is going to keep constant pressure on our financials. So I also asked the question in here again, what's a repo? I'll tell you what a repo is. It's a marketplace that's seized, okay, that now has to be financed by the Fed. That's the bottom line with like the repo market. Let's not get into, people want to get into the context of like, I didn't even know this thing existed. Listen, all of these banks, okay, they have short-term debt obligations that they can't meet every day, every night. Okay, so what do? They go to the repo market. Okay, they get me some of that cheap money, some cheap overnight money, and that's exactly what they do. Except that cheap overnight money wasn't there. Okay, it's again, everybody has their hand in the cookie jar until the cookie jar is empty. So the Fed has to step in. What do? QE reboot. Now again, they don't call it quantitative easing, do they? They call it liquidity injections. What do you think quantitative easing is? All right, it's a liquidity injection. The only way to put this is, okay, they're going to have continual problems. Like if this is the repo jar, they're going to have continual bottoming problems because there is nothing in there, right? They can inject 75 billion, but this isn't getting, okay? This cookie jar isn't getting any smaller. It's only getting bigger, which means, again, they're going to have to expand the balance sheet. It's QE reboot. That was actually the theme. Is the Fed bringing back quantitative easing? You better believe it. One way or the other, it's coming back, okay? Next point I want to make over here under the big bid is back under bonds, baby. It's a Fed free-for-all. What the Fed basically told you, okay, on Wednesday when Jerome Powell came out. First of all, Powell, I felt, was extraordinarily guarded, okay? And I'm telling you that decisions were made, okay, based on what he said in his speech. Decisions were made in terms of the Fed cut completely and utterly on the fly, all right? These people were like, hey, listen, we had a repo seizure on Monday and Tuesday, and they're meeting on Wednesday, and they basically said, we have to cut now. Okay, they couldn't have engineered this. There's my conspiracy theory. They couldn't have engineered this any better to work out. The Fed free for all, okay? Moving forward, there is no guidance from the Fed. You don't need guidance from the Fed, okay? Because you know the path of the Fed. Sooner or later, they're going to take those rates back down. They're going to kick on quantitative easing. The Fed is dead for right now. All right, next, we're going to go through a number of stocks over here because the markets appeared to start to roll over in some very key areas, and I want to get very, very specific with you. First on the list, Amazon. Amazon sees some fairly good sell-side activity. Hey, listen, I know it's some news-driven event, but Amazon, okay, watch this very carefully in the coming trading sessions. It has been an incredibly tight range. And where Amazon goes, this is a massive market cap that would weigh on the entire Nasdaq, not to mention weigh on the S&Ps. I know this is news driven, okay? If you're looking for a trade, any bid back to the upside inside of Amazon, look for a short duration in-out spread to the downside. Onward and upward. Next one I got to bring up, okay? Streaming service, Roku. We had a spread on Roku. We were completely and totally dead. This was a bearish spread. We put a bearish trade on Roku back over here, okay? Followed the rally all the way up, fell flat on our face, right? The amount of volume that's trading in here is insane. I mean, they basically traded their entire float pretty much today. Nevertheless, this is not contained to Roku. This is not a position that I'd be jumping into right now, either long nor short. And you know, when people ask that question, like, hey, would you get into that? That's when I'm going to start looking at things like the IV percentile. Okay, this is how implied volatility is kind of viewing risk, and right now it's still very much middle of the road. That's something I'll explain a little bit more as the week kind of progresses over there. Next on the list. All right, it's streaming like mania over there, and Netflix. We got to bring up Netflix. Okay. Again, some fairly heavy sell-side activity in the last two trading sessions. Again, volume spiked. I know there's competition, there's this, that, and the other. Okay, but the bottom line with Netflix, once again, I'm going to reiterate this. You're not going to see me get long. The volatility, okay, percentile, the volatility rank, if you will, is still incredibly low. The other thing that's really low in here is historical volatility. That's actual price movement. I don't like it, not one little bit. I am not going to consider a long position, okay, at this point. However, I want to reiterate something, okay? I have an in-out spread already on Netflix, okay? That, people, is not going to go well for me at this point. This is a time, and I love to bring up stuff like this, you know, on these discussions. This is a point in time where you look at your in-out spread. It's a 250 wide in-out spread, and you go, I am thankful that I had a defined risk position on this. Okay, this is one of those in-out spreads where I don't think it's coming back, but you know, I only paid like about $1.20 for this spread right here. I paid about $1.20 for it, and it's still got about 75 cents of salvage value. Okay, any mild bid back into Netflix, any mild bid back to the upside, bail, duck, dive, jump, take your money, okay, and run onward and upward. Now we move on to Microsoft. Okay, I've been very critical of Microsoft lately. Again, heavy volume in the last 2 trading sessions. And this, people are going to blame it's quadruple witching. That's why the heavy volume over there. I actually think Microsoft may have actually seen a key reversal. I mean, you're talking about, again, you have to bring up a maximum chart. That's it, people. That's it. It's the all-time high. Okay, this is the all-time high, has kind of a key reversal on it. Again, if you're looking for a position in here, this is going to be a short position, but you got to be careful of the earnings announcement, which is just about a month away, onward and upward. Again, if you're in tune with what I'm saying over here, you got Amazon that looks like it could break lower. You've got actually Microsoft that looks like it had a key reversal. Okay. We're not done. Now we're actually going to look at a couple of underlyings, like, for example, the next one on the list is Caterpillar. The reason I'm so into Caterpillar right here, right now, okay, Caterpillar, well, the interesting aspect of this, it's been involved heavily in the most recent rally inside of the S&Ps, and now it is starting to give some of that back. And it is going to be a little bit disconcerting here in the very near term. Again, I am carrying short positions inside of Caterpillar. I have been carrying short positions for a substantial period of time. Again, watch. Very, very low implied volatility in here. Again, extraordinarily low implied volatility. This was an absolute rip your face off rally. Again, looks like it's coming in at this point in time. I'm also going to go on to Costco. Costco, that was it. All-time high in Costco, sliding quite rapidly. Earnings coming up in the very near term. All I'm doing is pointing out these are stocks that have carried this marketplace. Again, stocks that have carried this marketplace. Again, another unsung hero of carrying this marketplace is none other than Intel, which had an explosive rally off of the bottom. Looks just like Caterpillar. Looks like all of them. As I said, okay, this is a marketplace where you kind of asked yourself, are we massively unchanged? Does Intel look massively unchanged? Does it? Okay, because one of the things that you're missing over here, if you look at Intel, this thing smashed through its expected move. Right? It smashed through its expected move. What other stocks do we have on the list over here? Okay, go take a look, for example, all right, at Amazon. Okay, Amazon smashed right through the bottom of the expected move. These are making, statistically speaking, okay, extraordinary moves. Right? Netflix smashed the bottom of the expected move. Don't even make me bring up like Roku. Even something like Boeing, which I didn't even have on the list. Boeing hit the top end of it. It even rolled over a little bit today. Okay? What else do we want to finish up with? Apple. Now, Apple isn't necessarily like a key reversal, nothing of the kind. It had some sell-side activity today in this quadruple witching. The reason, though, I bring up Apple is, well, today's the day that the new phone went on sale, and I think a lot of people are surprised that the stock may have reversed. The new phone goes on sales. There's lines out the door. Okay, all the millennials came out of their parents' basements, huh? Oh, come on, that's funny. They came out of the parents' basement once a year to buy their new phone and come back into the basement. Nevertheless, Apple has kind of a nice reversal inside of today's session. Keep an eye on all of these in the days to come. There are trades a-cooking in here. All right, now, watch those risk markers, people. One of the last things I'm going to leave you with in this weekend's update are some of the risk markers. So, down to the bottom of the screen, we got to look at the VVIX. And why am I looking at the VVIX? I bring this up like incessantly lately. There is something wrong. Okay, we are, listen, I don't mind saying there's a couple of stocks breaking down, yada, yada, yada. We're like basically at the all-time high. We're at the all-time high, but this volatility of the VIX that all the professionals know about this, right? They won't back it down. There is risk afoot in this marketplace. Listen, today, today in today's marketplace, if you look at the S&P futures, okay, that was because trade war. Maybe there's something in the trade war that's keeping traders on edge. Maybe it's something that the admin tweeting is keeping traders on edge. Okay, listen, it's just cyclical rotation of horrors. It's tweet after this, after what? Trade war. It just keeps coming back around. Nevertheless, okay, that VVIX won't back down, nor will gold. If this was just like one factor, I really wouldn't care. Seriously, if it was just the VVIX, I wouldn't care. But gold, even in the midst of that wicked rally inside of the S&Ps, gold isn't just resilient. I mean, gold is, carrying its weight. Take a look at it. Since June, has ripped higher, doesn't back down over here. All right. Then you also look at the volatility futures. The volatility futures. In the short duration, yada, 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 nobody cares. But when you start going out and looking a little further out in time, and this is something I want to reiterate out here, okay? Quick glance. Yeah, listen, we're not in backwardation, but we're really close. For the most part, the 61-day risk is the same as the 89-day risk, okay? That just reeks of something's up. I mean, even to 124 days. This is like saying that the VIX way out here in the future is way higher than it is in the near term. And you gotta read into that. And last, but definitely not least, I end, as I said, with the expected move. Okay. Now here's one again that's kind of got me looking and got me really starting to look. So I'm just going to take you back to last weekend. Last weekend, we talked a little bit about risk, and the expected move was about 42 bucks, about $42 last week. Now, if you take a look, we had this $42 expected move. You realize this is the first week, okay, in a very long time that we didn't hit the upper edge, okay, or a lower edge of the expected move like we've done in almost every single recent trading week. I wanted to reiterate that, okay, because in almost every single recent trading week, look at them, okay, we hit it here, okay, here's a week that we did not hit. We hit here, okay, here we actually came stones through. We hit it. Okay, we hit the expected move. We smashed the expected move, smashed the expected move, smashed it, touched it down here, up here, broke through it, hit the expected move there, hit the expected move there. Here's a week, okay, nothing happens. And why am I a little concerned about that? Because we had a $42 expected move. So this past week, we have a $42 expected move. Nothing happens. Boo, dead, right? Now, am I missing something? We were massively unchanged. But the expected move widened out this next week. Okay, what it widened out to? Well, that's why you got to go look at an option chain. If you look at the September 27th, it actually widened out to $47.51. Okay, so you got an extra, $5 packed in here? You don't have one of the most important Fed meetings in recent history this next week. The marketplace this coming week sees risk. You need to be aware of that. The marketplace in the coming week sees risk. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.